So you have to kind of ask yourself, oh, are the insurance agents really that greedy with these upfront commissions, or the mutual fund business? It's pretty much the same thing, around a 5% commission when you sell it, except for the insurance company doesn't take it out of your principal, but the mutual fund company will. Or you could do around a 1% commission on the back end. And I'm not making an argument for insurance companies. Annuities aren't going to make you rich. Welcome to How to Retire on Time, the show that answers your retirement questions. We're here to move past the oversimplified advice that you've heard 100 times. Instead, we're going to get into the nitty-gritty, because the truth is there's no such thing as a perfect investment product or strategy. Heck, there's no such thing as a riskless retirement. That's why it's so important to put together a retirement plan, one that's right for you, that's designed to last longer than you. That's why we do this show. Text your questions to 913-363-1234, and we'll feature them on the show. David, what do we got today?
Hey, Mike, are there other high commissioned products out there, like annuities, that I should stay away from?
Oh, the irony of this question. So insurance products get a bad rap because they're high commission products. Oh, watch out for those high commission products. Oh, the scandal, the how dare they? Let's go through some investments or products and really talk about the investment options here, okay?
Okay.
So, and this is going to be very transparent because people ought to know. I don't see any reason why people shouldn't know how other people get paid.
Fair enough.
That's, power to transparency.
Yeah.
So if you buy an annuity, they're going to receive anywhere probably in the ballpark of 5 to 7% upfront commission, and there might be some back-end negotiated overrides just to sweeten the deal. There's nothing wrong with that, okay? Many times it's not a fee to you. Like if you buy a fixed indexed annuity, that the insurance company is going to pay them a back-end fee, but it doesn't come out of your actual money, okay? Because the insurance company knows they're going to have some money in there. There are surrender penalties, and so if you take it out, they're made whole again. But at the end of the day, they're saying thank you for giving us the business. The insurance agent really is brokering these deals. They're not a broker-dealer. They're not an investment advisor. They're an insurance agent. But that's kind of the role, is to match these things up. Be careful of the fees within these different products. So for variable annuities, these aren't commissions, but they're just variable annuities tend to have higher fees. MIGAs or fixed annuities, so like a CD from an insurance company, tend to have lower fees. They might be like a 2% or a 1% kickback. It's very, very low. Fixed index annuities, about 5 to 7% or so. But that's just how they get paid. Now, there are ways that insurance agents can get paid out that are a little bit different. And I'm telling you this as a preface for everything else I'm going to tell you, okay? So you could take a one-time lump sum commission and you're done, okay? You could do like a 1% for the life of the contract. Like there's different ways you could structure the payout from the insurance company, okay?
This is what the agent chooses when they're...
Yeah, you choose how you want to get paid out.
Okay.
And so some agents will do the 1% because they want a residual, they want an income stream, and however they want to get paid, it's fine. It's as long as it's being disclosed, people don't tend to have an issue with it. The problem though is we've distorted. Oh well, don't buy an annuity because the person selling you is going to get a higher commission, but the securities people don't. That is not true at all. So let's talk about some alternative investments. These are investments where you're not going to get it from your basic strip mall advisory practice, the big names where they give you the typical portfolio. This is the more advanced stuff. You have to be an accredited investor, so meet a certain suitability threshold of assets and income and so on to qualify for these types of investments. But you've got things like privately traded REITs. Now look, a privately traded REIT, if you do your research, might be better than a publicly traded REIT, okay? Because it's illiquid, so they have more capital going to the investment side of it than a lot of cash on hand in case you redeem it, like a publicly traded REIT would have to deal with. So a privately traded REIT, not bad, but they're going to receive a 5+ commission, typically on the back end as well, okay? Not the end of the world. You can't get it unless you go through an advisor, but they're going to get paid. So you got other ones. Okay, let's go down the list. You've got other alternatives like private equity or hedge fund access. So people say, "Oh, I want private equity. That's what the rich invest in." Not necessarily. Okay, some very wealthy people stay only in the public markets, but you could. But there may be a back end commission, around 5+% as well, 5-6%, depending on the offering, or access to a hedge fund because it's like a finder's fee. So it's kind of a similar situation here. You go, you buy a real estate buy some real estate, the agent's going to get a commission to
Yeah.
help you negotiate and find the real estate. That's not an investment advisor but you get the idea here.
Right.
Delaware statutory trusts. So if you want to sell your real estate and you want to go into a DST to defer the taxes, so you don't pay taxes on the sale of your property, do a 1031 exchange, someone's going to get a back-end commission. I think it's typically around 5.6% or so. Now, these aren't hard commission numbers. Like, they can change. Oil and gas partnerships, limited partnerships. So you go down these lists of these alternative investments, and many times they're around a 5 or higher commission rate that someone's going to get paid. Now, what's interesting, by the way, quick caveat, is you have to have a Series 7 license typically to get a back-end commission for this. I don't have a Series 7 license. So you might say, well, Mike, can you offer these things? Well, yes, I can. But like if you do a DST, for example, I can't accept the commission. So instead of me receiving the commission, it gets rolled up into the client's money. So they put X number into the DST, then they get a little like that extra roll up or kickback or bonus because I can't accept it.
And that's by design on your part? Or?
Yeah, I don't like conflicts of interest. Anytime I can avoid it, I'm trying to get rid of conflicts of interest.
Okay.
That's just it. I sleep better at night.
Yeah.
Just charging. This is how much time it takes to do the job. Are you willing to pay my hourly rate to get it done? So if you have a more complicated situation, you're going to take more of my time. It's going to cost more. But if it's simple, then it costs less.
Yeah.
I don't want to be pushing a product for the commission. I want to do what is right for people. That's why we go off this flat fee schedule or this hourly rate schedule, whatever is right for the person based on the work. I think that's the most ethical way to do this. All right. Now let's talk about the one that most people don't realize.
Okay.
Mutual funds.
Yeah.
It is very ironic that the securities industry is out there saying don't buy annuities because of their high commissions when many companies, I'm trying to keep this very light,
Okay.
will say, oh, you want a portfolio? Great. We're going to put you into these funds, these mutual funds, whether you realize they're a mutual fund or ETF or not. That's a totally different topic. But they're going to put you in a mutual fund, and the agent gets around a 4.5 to 5.5 up to, FINRA regulates, up to 8% upfront commission. And guess what? It comes out of your money.
Oh.
You put $100,000 in there as a 5% commission. You just paid 5%, and and then now you're investing in the mutual fund.
All because the advisor put you in that fund.
That's how they get paid. And then, I mean, this is a bit grim, but like you might think, well, why don't they keep talking to me? I've got my mutual funds in there. That's not really how the business works for these types of advisors.
Sure.
Not all advisors. Let's not do blanket statements here.
Yeah.
All advisors are set up differently. But the ones that might ignore you might be because they already got paid, and maybe they are looking just for new business to get them into a good portfolio, and that's kind of it. Some mutual funds, these are like C-share mutual funds, there might not be an upfront commission, but it's like a 1% or so, 1.5% back-end commissions that you're paying, and it may not be disclosed. So you have to kind of ask yourself, oh, are the insurance agents really that greedy with these upfront commissions, or the mutual fund business? It's pretty much the same thing, around a 5% commission when you sell it, except for the insurance company doesn't take it out of your principal, but the mutual fund company will. Or you could do around a 1% commission on the back end. And I'm not making an argument for insurance companies. Annuities aren't going to make you rich. Mutual funds have a higher chance of growing your wealth, have a higher chance of capital appreciation. They're built for growth.
Yeah.
So please don't say, well, I'm going to go with this because it's a more ethical fee structure. No, it's not. They're different. They're apples and oranges. You've got hammers, you've got saws, you've got other tools. I'm not a contractor. But the irony of the situation, how we want to hate a group of people, is really interesting. Really interesting.
Sure.
And then what was the question again?
Yeah. So the question is, are there other high commission products out there like annuities that I should stay away from?
So I want to get rid of high commission just for a second.
Okay.
The question is not about greed. It's not about products. Really, the question should be, what is the right investment or product for me for this part of my portfolio to achieve a certain goal or purpose? Here's what I mean. If you want to be prepared for a market crash that could last 5 years, okay, you don't want lifetime income. You just want enough protection for about 5 years, so if the markets go down, you can sail through it.
Yeah.
You've got some options. You could do a 5-year CD ladder that just continues to roll. Now you've got reinvestment risk, but that's one way to do it. Or you could do something like a fixed index annuity with a 5-year period certain clause. Not all of them do this, but some of them can. I only know about 3 to 5 companies that actually offer this, but to where it's growing at a better rate than a CD should, because it's based on higher caps than with the S&P 500 than like a fixed rate from a CD company or a bank. But then whenever the markets do crash, you just call the insurance company and say, hey, 5 years income, and it's not at a fixed rate and it goes for 5 years. You sail through that market crash, right?
And there's no reinvestment risk with that because it's
contractual.
It's contracted. Here, it's all spelled out. This is it for 5 years. You get this.
Yeah. So what's the better tool? Now, for some people, the CD ladder is the better tool. For other people, it's going to be the fixed index annuity for that 5-year, we call it bear market protocol or protection, okay? Which one's right for you? Let's get rid of this, oh, well, one pays a commission, the other one doesn't. Whatever. I don't care. Which one is right for you, and can we articulate that? Some people don't want that upside potential but no downside risk because it's not guaranteed growth. Some people want the structure of a CD ladder because they know exactly the fixed rate they're going to get, or the bond ladder. They know exactly what they're going to get. From a suitability standpoint, emotionally, that's better for them. But for other people, they don't even know this other option exists. And there's so many different ways that you could solve for that. So you don't go to a heart surgeon and say, hey, perform heart surgery on me, but please don't use those tools or those medications. I don't want to crank up the bill or whatever it is. It's like, please save my life.
Right.
In finance, it's not about how do you get the advisor paid the least and how do you pay the least in fees. It's net of fee. Forget about commissions. Forget about what is the best thing for you. That is the conversation that needs to be had. Now, one thing that I caution people against is there's many right ways to go. Are you exploring all of the various different ways? So, for example, when people want protection, usually it's, okay, well, here's CDs and treasuries for protection, kind of the security side of things. Here are bond funds, which you can get back in commissions for and all that, whatever. But that's kind of less risk. And then you have the insurance people selling annuities. But very few people are talking about buffered ETFs, structured notes. Structured notes, they do have a back-end commission sometimes, but not all the time. So are you having that expansive conversation, and are you understanding the tools available to you and the benefits and detriments associated with them or not? That is what gets my goat. It's not about avoiding high commission products.
Yes.
Because I would personally rather pay the 5.6 or whatever commission it is to sell real estate property, defer taxes, maintain my cash flow, and use a DST, than paying 20 to 30% in taxes because I didn't want someone to make a 5% commission.
Right.
Do you see how sometimes we kind of misalign this? Ooh, I don't want to be taken advantage of.
Yeah.
If you can have an open conversation with someone, if they're openly transparent about everything, it's a very fun conversation because now you're really exploring your options, your potential.
Yeah, so it sounds like we shouldn't be trying to avoid things. This list of all these opportunities here, you shouldn't avoid them just to avoid the fee or the commission, but just do what is right for you and speak openly.
Yeah, trust is so deteriorated that we just assume the worst in people now, and that's really unfortunate.
Yeah, right.
So, I mean, that's the tough part about all this. Find someone that you can have a conversation with where you can build trust and respect that will spend as much time as you need and really explore these options for you and just say, here's this idea. And here's the secret. If they openly explain the detriments, and there's often more detriments that they're talking about than benefits, explaining any product, any investment, any strategy, they're probably being transparent and honest with you. If this is the only way and it's the best way and don't ask me more questions, that's the red flag to watch out for. Hey, thanks for watching this video. Make sure that you like and subscribe first, and then go to www.retireontime.com to grab a copy of my book, How to Retire on Time, take a few courses about retirement, join my newsletter, and so much more. Now, if you want to work with one of our advisors here at Kedrick Wealth, who can help you put together a retirement plan that's designed to last longer than you, just click the button, Get Started. Everything we do is intended to help you retire on time. We hope you enjoy, and we'll see you in the next show.